Assalamualaikum. Today our group will take you through one of the most disruptive emerging forces reshaping the modern financial landscape, artificial intelligence in auditing. Artificial intelligence AI is a technology that uses knowledge, insight, and perception to perform cognitive tasks that only humans could previously perform. In auditing, AI is no longer experimental as Big Four and mid-tier firms now use it across planning, evidence gathering, and reporting. Recently, it reveals that large public accounting firms are deploying what they term simple AI, such as robotic process automation, to automatically extract critical data from unstructured corporate leases and contracts. Simultaneously, they are advancing towards advanced AI models driven by a deep machine learning to perform predictive anomaly detection and continuous transaction testing across complete financial cycles. While these capabilities offers incredible efficiency, they introduce a massive structural conflicts with traditional accounting and auditing concepts. The core issue is that our current regulatory and standard frameworks, such as the ISAs, were fundamentally designed around a human-driven, sampling-based methodology. For over a century, because checking every financial record manually was physically impossible, auditing relied on extracting a statistically significant subset of data to infer the compliance of the entire financial population. AI completely shatters the traditional paradigm. By enabling 100% population testing and continuous auditing, AI eliminates traditional sampling risks entirely. However, standard setters are facing a massive hurdles because current frameworks offers a zero explicit guidance on how human auditors can legally back, document, or verifying a machine-generated audit evidence. This brings us to the ultimate regulatory dilemma, the black box problem. Advanced deep learning structure functions through hidden layers where the exact data pathing is mathematically opaque. This opacity directly clashes with the foundational requirement of professional skepticism. Auditors are professionally mandated to maintain a questioning mind and critically access evidence. But how can an auditor maintain skepticism toward an algorithmic output they cannot structurally see or understand? Without clear technical guardrails, auditors risk becoming passive rubber stamps to automated systems, creating an alarming accountability gap if an AI fails to flag a material fraud. Traditional rules are simply struggling to bridge the gap between automated machine speed and human professional responsibility. With this core problem established, I will now pass the presentation to Najiha, who will analyze the real-world impact of this issue.
Assalamualaikum. My name is Siti Nurnacha binti Buhanuddin, and today I will explain about real-world impact of AI in auditing. Firstly, AI improved the operational efficiency of audit firms by automating repetitive tasks such as data entry and transaction analysis. This allows auditors to complete audit process faster while reducing manual work. For example, in the article, EY has automated over 250 audit operations and saving approximately 2 million human working hours annually. Besides improving efficiency, AI also enhances audit quality because it can analyze large amounts of financial data more accurately than traditional methods of audit sampling. AI also enables continuous auditing and real-time monitoring of financial transactions, allowing companies to detect errors, fraud, or compliance issues much earlier instead of waiting until the year-end audit. However, there are also some negative impacts. Implementing AI requires significant investment in technology, employee training, and cybersecurity. Since AI processes confidential financial information, businesses also face a greater concerns regarding data privacy and security. In addition, some employees might be reluctant to adopt AI because they're worried about the job displacement and changes to their professional roles. Next is the impact of AI on investors. AI benefits investors by improving the reliability and credibility of financial reporting. Since AI can analyze 100% of financial transactions instead of only selected samples, it increases the likelihood to detect fraud and financial misstatements. AI also improved transparency by producing more detailed audit reports with clearer insights and making financial information easier for investors and stakeholders to understand. As a result, investors can make a better informed investment decisions based on a more accurate financial information. On the other hand, AI also have some negative impacts to the investor. If AI systems are trained using biased or inaccurate data, they may generate a misleading audit conclusions. This can reduce investors' confidence and affect their trust in the financial reporting. Furthermore, unsuccessful AI implementation may undermine public trust if the audit results are inaccurate or unreliable. Moving on to the real-world impact on the economy. One of the biggest positive impacts is increased productivity and operational efficiency. AI automates many routine auditing tasks, allowing organizations to save time and improve overall performance. Some studies even estimate that AI investments could contribute to 6.6 trillion US dollars in global productivity gains by 2030. AI is also transforming the auditing profession. Instead of spending time on the repetitive work, auditors can focus on data analysis, strategic decision making, and providing advisory services. At the same time, AI strengthens market integrity by improving the detection of fraud, money laundering, and financial misstatements, which contribute to a more transparent and stable financial system. Despite these benefits, AI may also lead to employment displacement as more routine auditing tasks become automated. Another concern is that large firms can invest heavily in AI technology, while smaller firms may struggle to keep up. This could widen the technological gap between the large and small audit firms.
Now let's look at the main problems people are facing when they try to use AI in auditing. The first challenge is transparency and explainability. The first problem is that AI is hard to understand. Many AI tools work like a black box. They give you an answer, but they don't tell you how they got there. This is a big issue in auditing because auditors don't just need an answer, but they need to be able to explain and defend the answer to regulators, to clients, and sometimes in court. If an auditor can explain why the AI flagged something or why it didn't flag something, that becomes a real problem during an inspection. The second problem is the bias, which is the AI might give unfair or incomplete results because it wasn't trained properly. In auditing, this usually happens when the AI is only trained on some accounting rules, not all of them. So it might miss something important simply because it was never shown that information. This kind of gap can be very hard to notice because the AI will still confidently give an answer. It just won't know what it doesn't know. The third challenge is data privacy. AI needs a lot of data to work well, but using more client data means more risk of exposing private information. Researchers even found that if you train AI using one client's documents, it might accidentally reveal patterns that help someone guess details about a different client. So firms have started using data very carefully only to improve the AI slightly, not to compare clients directly. And the fourth one is human elements and behavioral risk. Under that, we have two, which is auditor over reliance, which is people problem, not a technology problem. There's a risk that auditors will trust AI too much and stop thinking critically. Over time, this can weaken the auditor's judgment and their ability to question things, which is really the core of what auditing is about. Because of this, firms are now telling auditors that AI results are only suggestions and the auditors still have to check the work themselves. Other than that, we also have skill gaps and de-skilling. This is a skills problem and it works in two directions. On one side, auditors need to learn new skills to understand and use these AI tools properly. On the other side, firms worry that if young auditors rely on AI too much, they won't develop the basic skills they need. This is called de-skilling. So companies want AI to help but not replace the learning process for new staff. So last but not least is the lack of regulatory guidance. Tying all of this together, there's a bigger problem sitting above everything else, which is the rules simply haven't caught up. AI technology is moving extremely fast. New tools and techniques are being developed constantly, but the accounting and auditing standards that are supposed to guide how this technology should be used are moving much slower. Right now, there is no clear official standard that tells auditors exactly how they should test, trust, or rely on a complex AI system during an audit. This isn't just true in one country, it's a global game. Major standard setting bodies, whether we are talking about IFRS and MFRS internationally, haven't yet built out proper guidelines for it. Moving on to the gap and weaknesses in the accounting rules to solve this problem. The first issue lies in MFRS 138, which governs intangible assets. We all know that data and continuously evolving algorithms are what give an AI system its true value. Yet, under current regulations, immense costs of gathering data and training models cannot be capitalized on the balance sheet. Instead, they must be written off immediately as standard operating expenses. This creates a massive gulf between a company's actual market worth and what is officially reported on its balance sheet. Our second gap is transparency. Traditional accounting relies on a clear, verifiable paper trail. AI, on the other hand, operates autonomously. Advanced deep learning models function as a black box, making it nearly impossible for accountants or auditors to trace exactly how a system calculated a specific financial estimate. On top of that, if an autonomous system makes an algorithmic error that wraps financial data, our current standards don't give clear instructions on how to legally classify or report that liability. Finally, we have the hurdle of verifying AI-generated content. More and more companies are using generative AI to write corporate narratives and financial disclosure notes. Current accounting frameworks assume these disclosures are the direct product of human oversight and intent. They offer zero guidelines on how auditors should verify that this automated text is entirely accurate and not just a clever hallucination cooked up by a chatbot. To rate up, as AI takes over both corporate numbers and corporate writing, our accounting frameworks desperately need an upgrade. Until regulators bridge these technological gaps, financial statements will fail to reflect the true economic reality of modern business.
Moving on, I am presenting a four-part solution to bridge this gap. We will look at practical steps for four distinct groups, including standard setters, corporate leadership, individual accountants, and also teams that are responsible for managing internal data. First, we need action from standard setters like the IASB and FASB. The most urgent step is updating IAS 38 for intangible asset. Rulemakers must allow companies to capitalize AI costs. This means recording them as a real assets on the balance sheet instead of just write off them as R&D costs. Second, we must modernize fair value rules. Standard setters need to recognize online data marketplace as a valid place to find market price for proprietary data. Third, we must account for the heavy electricity costs of running AI servers by deducting these environmental expenses from the AI's total value. Finally, standard setters must require regular implement testing. AI can become audited quickly as the market conditions change. Therefore, rules must force companies to test their AI yearly to ensure its recorded value hasn't dropped, preventing material misstatements on their financials. Second, companies and audit firms must improve their internal controls today. They cannot afford to wait for official rules to change. Companies must break down department walls and create mixed committees where accountants, IT experts, and lawyers work together to review new AI software before it is used. Also, leadership must ensure the teams building these tools come from diverse backgrounds. If a team thinks the exact same way, they might accidentally program human bias into the software and creating a massive financial risk. Next, firms must provide basic technology training so accountants understand how AI tools generate their numbers. Lastly, companies should start making voluntary disclosures. Even if they cannot put data directly on the balance sheet yet, they can explain the usefulness of their data in the notes to the financial statements to show investors their true worth. Third, let's look at the individual professional accountant. Using technology makes your job much more focused on ethics and also high-level review. The most critical step is to keep a human in the loop. A major danger today is automation bias, which the temptation to blindly trust whatever numbers a computer dashboard prints out. The human accountant
must always apply professional judgment. We strongly recommend that audit managers perform strict reviews of any custom spreadsheets or time-saving bots built by junior staff before they use on a real audit file. Finally, maintain professional skepticism. AI only knows past data and lacks of common sense. The future accountants must question the system, not just passively accept the numbers given to them. Moving on, we must improve everyday internet practices to make our reporting transparent. We strongly recommend banning black box AI in financial reporting. This is software that spits out an answer without explaining how it got there, which is completely unacceptable for an audit. AI software must leave a clear and also easy to read audit trail. We also need ethics by design, which mean internet controls, accounting standards, and privacy rules are programmed directly into the software from day one. In order to verify this, CPA firms must hire IT experts to work directly alongside financial auditors to check the computer code and verify the data is accurate.
To bring our presentation to a close, let us synthesize what these emerging issues means for the future of our profession. Our systematic review of these academic studies demonstrate that AI is not a passing trend or a minor software upgrade. It is a profound, a permanent game changer that is reshaping the very fabric of how financial integrity is measured and verified. As we have demonstrated, routine, repetitive tasks such as data entry, manual transaction testing, and basic data extraction are rapidly becoming fully automated by machine learning algorithms. Consequently, the traditional industry image of an accountant or auditor as a mere number crusher is officially obsolete. For us, as students and future professionals about to enter this changing market, this demands an immediate shift in the mindset. To remain resilient and highly competitive, we must cultivate a hybrid mindset. It is no longer enough to graduate with a deep technical memory of MFRS or IFRS accounting standards. The market now requires us to pair our financial reporting proficiency with advanced data literacy, algorithmic oversight abilities, and interdisciplinary collaboration skills. We must become professionals who understand how data streams fit into an algorithm, how to actively audit the algorithm itself from hidden historical databases, and how to interpret complex machine-generated anomaly flags. Our values will not lie in gathering data, but in interpreting with the highly complex risks that data reveals. Ultimately, the most critical takeaways from our research is that while AI possesses unparalleled analytical speed, it is completely lacks context, ethical reasoning, and true professional judgment. The ultimate resilience of the accounting profession rests on the human elements. Algorithms can automate calculations, but human professional accountants must retain final active and legally binding veto power over critical accounting judgment. We must step into the market not fearing AI as a threat, but leveraging it as an analytical superpower, while standing firm as the absolute ethical gatekeepers of global financial integrity.